So let's continue to our December 2024 management accounting question paper. So Boston Limited uses standard costing system in its factory and started trading on 1st April 2023 for manufacturing and selling one product. The standard cost per unit was direct material, standard price 10 rupees per kilogram, standard quantity 20 rupees per kilogram per unit, direct labor, standard rate of pay 5.5 per hour, standard time allowance 12 hours per unit, production overhead cost all classified as fixed but budgeted at 9 lakh per annum. The standard time for producing one unit is 12 machine hours and normal capacity is 60,000 machine hours per annum. Production overhead is absorbed on machine hour. So for the year ended 31st March 2024, the cost incurred and other relevant information are given below. Direct material used 1 lakh kilograms at the cost of 10 lakh 50,000. Wages, production overhead, machine capacity used, actual output 4,800 units. Assume no stock in work in progress or finished goods at the year end. You are required to calculate the standard product cost for one unit. Unlike the variances for material cost, price, and usage. So in material variance, we need to calculate cost, price, and usage, labor rate, efficiency, and cost. Fixed rate, expenditure, efficiency, and capital and cost. So we need to calculate all the variances in a single problem. So comes to 14 marks. Usually, what we will do is we will forget to calculate standard product cost. We will be calculating all the variances, but we will forgot in a hurry. We will forgot to calculate standard product costs. Usually that happens in a hurry. We will forget to calculate something. So because we always used to calculate variances alone, right? So here, at least 1 mark will be given to standard product cost, even if you're calculating all the variances without calculating standard product cost, you won't get the full marks. So just you have to cross check once after finishing your answers whether you have calculated all the necessary items which they asked. So here, how we need to calculate standard cost. So direct material they have given. 10 rupees per kilogram. Okay, fine. So how many kilograms we required? That is 20 kilograms we required. So that means for producing one unit, I required 20 kgs. So 20 into 10, that means 200 rupees of direct material are required. So direct labor 5.5 per hour. So how many hours I required? 12 hours. So 5.5 into 12. So that means so 5.5 into 12. So 66 rupees. Then I have what else I have? This is direct materials, direct labor, and overheads. So this and all I'm calculating for per unit. So overheads also I want to calculate it per unit. So they have given 9 lakhs rupees per annum. So for 60,000 machine hours is required per annum. So 9 lakhs divided by 66,000. So I will be getting 9 lakhs, sorry, 9 lakhs divided by 60 rupees, 60,000. So I will be getting 15. So my overheads will be 15 rupees. That is 9 lakhs divided by 60,000. So this will be for 15 rupees per hour. So how many hours I require? 12 machine hours. So into 12. So I will get 15 into 12. So 180 rupees. So my total will be around 180 plus 200 plus 66. So I will be getting 446. My standard cost per unit is 446. Okay, fine. So what else I have? So now let's move on for calculating variances. So I need to calculate all the variances, material, labor, everything. So first, I'm going to prepare a statement. So what and all I require now, I'm going to go prepare for material variances. So what I need standard quantity for actual production. Okay, so what is my actual production here? How many units I'm producing here? Actual output is 4,800 units. So here for producing one unit, I require 20 kgs. So for actual production, that is actual units, 4,800 units. So 4,800 into 20. So that means 96,000. My standard quantity required for actual production is 96,000 kgs, right? Okay, fine. What is my actual? So direct material used 1 lakh kilograms at the cost of 10 lakh 50,000. So how much I used? Actual quantity is 1 lakh kilograms. So there is a difference between actual units and actual quantity used. So for producing one unit, I require so and so kgs, right? In this particular problem, I require 12 kgs. That is your standard. So 12 kgs of raw material. So based on this only, we are calculating. So in this particular problem, we require 20 kilograms, right? So for producing one unit, I require 20 kilograms. So for producing 4,800 units, how much I require? 4,800 into 20, that is 96,000. But actual quantity is 1 lakh kilograms. So 1 lakh kgs I required. My actual price is 10 lakh 50,000. So actual price per kg. So 10 lakh 50,000 divided by 1 lakh. So 10.5 per kg I have used. This is actual kgs. So now standard rate. Standard rate is 10 rupees per kilogram. So standard rate per kg is 10 rupees. So I have calculated all the necessary inputs. So for easy reference, how to remember the formulas easily, I have already posted one video in my YouTube channel. So you please refer to that for how to remember easily all the variances formulas. So let's move on to material variance. So first, let's calculate material cost variance. So usually, if the name suggests cost variance, the difference should be computed between actual and standard cost. So that means standard cost for actual production minus actual cost. So here standard cost for actual production is I require 96,000 units. My standard cost will be 96,000 into per kg is 10 rupees, right? So 96,000 into 10 minus actual cost is 10 lakh 50,000. So I will be getting 9 lakh 60 minus 10 lakh 50. So 90,000 is adverse. So cost variance is an adverse. Okay, fine. Let's move on to next variance. Material usage variance. So usage variance means the difference should be between material usage, right? That is standard quantity minus actual quantity into standard price. So what is my standard quantity here? 96,000 kgs, which we already calculated. So 96,000 minus actual quantity, that is 1 lakh, into standard price, that is 10 rupees. So again, this is an adverse variance, that is 40,000. Then comes to material price variance. So the difference should be between price. So standard price minus actual price multiplied by your actual quantity. The only formula which is multiplied by actual quantity is your price variance. So my standard price is 10 rupees, my actual price is 10.5. This everything is calculated per kg basis into actual quantity. That is 1 lakh. So this will end in 50,000 adverse. So we can cross verify this 40,000 and the 50,000. So I will be getting 90,000 adverse totally. So that should match with my cost variance. If it is not matching, we have made some clerical errors, so we can rectify it. So here it is matching 40 and 50. So 90,000 adverse I will be getting. So this regards to material variances. So we have completed material variances. Let's move on to labor cost variance. So labor variances, let's compute labor variance. So what we need, standard hours for actual production. So I require 12 hours to produce 1 unit. So totally we have 4,800 units. So 12 into 4,800. So I require 57,600 hours. My standard rate already given in the question is 5.5. So standard rate 5.5. My actual rate. So actual rate here, wages paid 3,10,000 for 62,000 hours. Right. So actual labor cost 3,10,000. Actual hours 62,000. So my rate will be 3,10,000 divided by 62. So 5 rupees. So here, if I'm comparing roughly that rate, my standard is 5.5, but actually I paid only 5. So it will end in favorable variance. Okay, fine. If you are remembering this formula, you can easily arrive labor cost. Only thing is, here I used a standard cost for actual production, right? Yeah, same thing. For here, instead of material, I want to substitute for labor. Here, usage. So instead of usage, I will refer it as efficiency. Instead of quantity, I will replace it with hours. That's it. Instead of price, I replace with rate. So my labor cost variance is equal to my standard cost for actual production minus actual cost. What is my standard cost for actual production? That is 57,600 into my standard cost per hour is 5.5 minus actual cost in question itself we have given 3,10,000. So if I am substituting this, I will be getting 6,800 favor. So don't miss to write favor or adverse. If you are not writing this favor or adverse, for sure we will be losing the marks. Then labor rate variance. So the formula is standard rate minus actual rate into actual hours. So standard rate in this problem is 5.5 minus 5 into actual hours, that is 62,000 hours. So here also we will be getting in positive 31,000 favor. Then labor efficiency variance. So efficiency in the sense it refers to standard hours. So standard hours for actual production minus actual hours. So actual hours used for production. You have to consider actual hours used for production into standard rate. So standard hours is 57,600 minus my actual hours is 62,000 into standard rate, that is 5.5. So I will be getting a adverse variance of 24,200. So here also I can reconcile this 31,000 and 24,200 together. I will be getting 6,800 in positive. So my cost variance is 6,800 favor. So my calculations will looks good. So let's move on to next question. Next calculations in the same question. So we need to calculate overhead variances, right? In this particular question, we need to calculate fixed overhead variances. So first, for fixed overhead, we need to know what is our budgeted hours. So budgeted hours, that is here I have 9 lakh rupees as budgeted overheads. So my budgeted overheads is 9 lakh, right? So 12 machine hour per annum, fine. So here we have standard time for producing 1 unit, 12 machine hours, normal capacity 60,000. So that means we have arrived this normal capacity, that is 60,000 will be my budgeted hours. So budgeted hours, it is assumed to be the same like a normal capacity. So 9 lakh rupees using 60,000 hours. So 60,000 hours is my budgeted hours. Okay, fine. So here in this particular problem, all the overheads are fixed. So here actual overhead is 9,26,000. So actual overhead 9,26,000. Actual hours, how many hours we used? So we are using 12 machine hours. So 12 into 4,800. So this should be 57,600 should be standard hours required for actual production for actual quantity. So 57,600 hours. My actual hours is, so we are using 60,000 machine hours. So again, my actual hours is 60,000. So then my actual rate, that is 926 divided by 60,000. So 15.433. Okay, standard rate that is already calculated in the question beginning itself, 15 rupees. So that is here itself we calculated 15 rupees per hour. So we have arrived all the necessary calculations. So let's calculate fixed overhead efficiency variance. First I'm calculating fixed overhead efficiency variance is equal to standard hours into standard rate minus actual hours into standard rate, or else You can remember efficiency is always between hours. So standard hours minus actual hours into standard rate. So my standard hours is 57,600, actual hours is 60,000. So for calculating overheads, I'm referring machine hours, not labor hours. You remember that. My standard rate is 15. So 36,000 adverse. Then let's move on to fixed overhead capacity variance. So remember, capacity is what is my budgeted capacity and what is my actual capacity. So that is the difference. So here my budgeted capacity and actual capacity is same 60,000. So there should be no capacity variance at all. So my capacity variance is 0. So remember, capacity variance is always calculated using budgeted hours and actual hours. So budgeted hours and actual hours is the main criteria here using. So you remember actual hours, if it is more, that the variance will be favored. So actual hours minus budgeted hours into standard rate. So here actual hours and budgeted hours is 60,000, both are same. So 60,000 minus 60,000 into my standard rate, that is 15. So I will end up in 0 only. So if you're remembering the formula in this way, it will be very useful. So if I am utilizing more than my budget, say for example, I can use only 1 hour, but I am utilizing by doing some overtime, everything. So I'm utilizing 2 hours means it is a benefit for me, right? So actual hours minus budget hours into standard rate will be the formula for this. Then fixed overhead expenditure variance. So fixed overhead expenditure variance is equal to budgeted hours minus actual hours. So here budgeted hours into standard rate I'm mentioning minus actual hours into actual rate. So that is budget hours into standard rate, that is 9 lakhs. Actual hours into actual rate, that is 9 lakh 26,000. So 26,000 is favor. Then fixed overhead cost variance. So you can easily add all these variances together and you can get fixed overhead cost variance. So that is 36,000 plus 0 plus 26,000. So this is an adverse. So 36 and 26, I will be getting 62,000 adverse. So what else, if you want to calculate a different formula, you can do it so. So here, so using formula, we can calculate that. So based on your standard hours, we can do. So here, standard overage is 57,600 into 15 minus my actual overage, that is 9,26,000. So 62,000. So you can calculate in this way also, and you can cross verify.